This was the action in the bond markets. You did see the macro numbers coming yesterday on both CPI and IIP. But the bigger story is the big bond sale that's on the anvil in the month of April. Ananth Narayan, professor at SP Jain Institute of Management, now joins us, a veteran in the markets. Ananth, thank you so much indeed for joining us. I was just talking to a colleague of mine. We were talking about how there's a big bond sale expected in the month of April. The government papers hit the market. Is that keeping the market right now on tenterhooks, because they didn't react too much to the CPI number, which undershot estimates?
Yeah, afternoon, Harsha. Look, a couple of issues are keeping the market at tenterhooks. The first is the fact that a vast section of the Indian bond banks are still not participating in bond markets. So public sector banks have kept away since middle of Jan. Even now they're net sellers and they're not showing any interest in the bond markets given where the levels are right now. So that technical issue has to be sorted out before we even come to some semblance of normalcy.
Right.
The second issue, as you rightly point out, is come the new fiscal year, we have a large borrowing program coming through with a wider fiscal deficit. We also have the states, which are going to be raising a lot of funds. And at the moment, there seems to be a mismatch between the supply and demand. There isn't enough demand to cater to all of that supply. So both these issues of the technical non-participation by Indian banks and this very evident gap in supply and demand is keeping bonds on tenterhooks. So yesterday's very, very good news on the CPI front, frankly, has not had the impact it should have had.
A couple of weeks ago, we were talking about bond yields touching 8%, and I'm now hearing targets of about 8.25. Where is this headed, do you think?
No, look, I don't have such a dire prognosis for bond markets. I think things will get sorted out. I think between now and March, there isn't really too much of supply to come through. But in April, I think some steps will be taken to ensure that full participation returns to normalcy. I wouldn't be surprised if between the government, RBI, and the affected banks, there is some, discussion tete-a-tete with where some of these issues are kind of sorted out. As I said, the issue of Indian banks not participating is kind of silly. It's the large elephant which is not in the room right now. And I'm sure it'll get sorted out at some stage. And once that happens, frankly, bond yields ought to be lower from where they are even today. The second larger question of how do you bridge this supply-demand mismatch which is there, that is a bigger problem too, if you ask me. The reality is, even if Indian banks come back into the system, it's likely that their demand will be lower than the last or this current fiscal, simply because credit offtake is a lot more robust. And the excess money that was there on account of demonetization has gone away. So there's no real, that kind of demand left in the system. And the second bigger question is the FPI. Last calendar year, FPIs invested $23 billion in the debt markets. And that was a big source of demand for bonds. Very unlikely that the limits will exist for that kind of participation. And even if the limits are opened up, it's a question mark as to whether in the current context, FPI would come in to the same extent they did last year.
Sure.
So that question again needs to be addressed, and it's a very involved question with no easy answers. I think there is demand for bonds from FPI, but if you were to open the limits to solve the bond problem, you would create an FX problem, because RBI then would have to intervene and mop up dollars.
Sure. And
risk getting called out by the US Treasury as a currency manipulator. Plus, FPI in debt has never been stable flows. We've seen times like June 2013 when we saw large droves of outflows from FPI in debt. So it's always a uncomfortable kind of flow rather than a comfortable one.
Okay. If the situation were to continue, that is, the government-owned banks not participating, we are essentially talking about a balance sheet problem, which is not going to go away very soon. What's the likely impact if, 1 month from now, if you're having the same conversation where buyers are absent, what's likely to happen then? I know this is hypothetical, Ananth, but bear with me.
It's hypothetical. No, it's a fair question, Harsha. I'm hoping it doesn't come to that because of a couple of reasons. One, we have the MSS bonds maturing. In fact, one is already matured, and there's some more tranches getting matured over the next few days. Plus, we also have a lot of redemptions happening in April. So a big chunk of bonds which are being held by Indian banks currently will go out of the system, will get repaid by the government. So which means some natural SLR demand or LCR demand from banks might emerge in the normal course of events. Having said that, if the larger issues of risk management and market risk management are not resolved, and if this impasse continues, and if people continue to puff their cheeks and say and sulk, absolutely yields can go higher from here. Every auction can see a tail which takes the market up by 10-15 basis points, and we saw that in January and February. So in that scenario, 8% can definitely be seen. But I honestly don't think we come to that. I genuinely think technical issues will get resolved. Sure. The other source of demand which I'm hoping does emerge is the last year, we saw very little money going into income funds compared to the year before. We saw only 60,000 crores going into income funds, whereas we saw AUM in equity and balanced funds go up by 4 lakh crores. I think this year around we might see less money going into equity funds and balanced funds, and maybe a little more going into FMPs and income funds. Now, that doesn't by itself translate into demand for government debt per se, but I do think bond demand in general will go up, and that will help government bond markets as well. So I'm hoping that both the issues, the technical issue of public sector participation, as well as the apparent gap between supply and demand, will get bridged before long. 8% or 7.75 to 8% on 10-year bond, frankly, is extremely rich. It kind of factors in many rate hikes from here. At some point, we are seeing overnight rates therefore go up to beyond 8.5% also if you have to justify 8% 10-year bond yields when the current overnight rate is 6%. I don't think that's kind of warranted. Clearly, we are going to see inflation capped at 6%. So 8% to me looks like a pretty rich rate where we all should be interested.